Welcome to the research desk.
Glad to be here.
So I want you to just step back in time with me for a minute and picture a very specific scene. The year is 1989. You are walking onto this massive, high-stakes institutional trading floor in New York City.
Oh, right. The era of the giant CRT monitors.
Exactly. Giant, humming CRT monitors on every single desk. And the air is just, thick with this overwhelming stress of managing billions of dollars of pension money. And we're talking about money that represents the retirements of teachers and firefighters, factory workers. So the stakes literally could not be higher.
No, absolutely not.
Right. Now, imagine you're holding a piece of paper. And on this paper is a mathematical recipe. But it's not just any recipe. It is the absolute theoretical foundation of modern finance.
Harry Markowitz.
Harry Markowitz. Exactly. It's the portfolio construction equation he developed decades earlier. And this framework is, well, it's a mathematical marvel. It's so profound, so mathematically elegant, that it's actually about to win the Nobel Prize in economic sciences the very next year, in 1990.
Right. It's the Holy Grail.
It really is. Every business school in the country teaches this exact recipe as unquestionable gospel. I mean, every finance textbook treats it as the absolute pinnacle of portfolio design because it promises this incredible thing, right? The exact mathematically perfect mix of assets to give you the highest possible return for whatever level of risk you're willing to stomach.
Yeah, on paper, it is flawless.
So you walk up to the senior portfolio manager, the person who is actually responsible for moving those billions of dollars in the real world, and you hand them this Nobel Prize winning recipe. And you ask them, how often they use it to make their daily decisions, and they look at you and they laugh in your face.
Yep, they wouldn't touch it.
The most celebrated, theoretically sound, mathematically perfect portfolio construction tool in the history of finance was in 1989 just completely ignored by the very practitioners it was designed to help. And I look at this historical situation, and I am genuinely incredulous.
I mean, it does seem crazy from the outside.
Right? Because I come from a quantitative background. We trust the data, we trust the algorithms. If something wins a Nobel Prize, if the math is flawlessly proven in academic journals, why would the professionals whose very jobs depend on getting the best returns absolutely refuse to use it?
So what was your initial assumption when you first looked at this?
Well, looking back at the 1980s, my initial assumption was that these Wall Street guys were just, stubborn. Like they were old school stock pickers who operated on gut feeling and Rolodexes, and they were just fundamentally afraid of complex mathematics they didn't really understand.
The classic man versus machine ego clash.
Exactly. If a machine tells you the optimal answer, you don't throw it in the trash unless your ego is threatened by the machine. I feel like we really need to understand exactly what was going wrong on that trading floor.
Well, that's a completely logical assumption to make from the outside, but it's entirely wrong.
Really? Entirely wrong?
Completely. The professionals weren't ignoring the math because they failed to understand it. They were ignoring the math because they understood it all too well. They understood what it actually did to real, actual money.
Okay, so they weren't just being Luddites?
No, not at all. And the definitive answer to your question was laid out in this just devastating 1989 paper by a quantitative researcher named Richard Michaud. His paper fundamentally broke the illusion of perfect mathematical investing. But to understand his critique, we have to start with the grand promise that Harry Markowitz made back in 1952.
Right. Lay the groundwork for me.
So before Markowitz, investing was essentially a beauty contest. You analyzed individual stocks or bonds, you found the ones you thought were the quote-unquote best in isolation, and you just bought a bunch of them.
Just picking the winners.
Exactly. But Markowitz completely revolutionized the field by proving mathematically that you should never judge an investment in isolation. You have to judge how it interacts with everything else in your mix. Some assets zig while others zag.
Oh, so it's about the combination.
Yes. If you combine them in precisely the right proportions, the overall risk of your portfolio goes down while the return stays exactly the same. To explain the two foundational terms Markowitz gave us, I want to use an everyday analogy.
I love analogies. Hit me.
Okay, imagine you are packing a survival backpack for a brutal, months-long wilderness expedition.
Okay. High stakes.
Right. Now, if you only look at items in isolation, You might logically conclude that fresh water is the single most vital element for human survival. So you pack your bag with nothing but 60 pounds of water.
Which would be a terrible idea.
Exactly. You would freeze to death or starve within a week. Instead, you need a combination: water, sure, but also a heavy canvas tent, high-calorie food, a medical kit. The perfect backpack isn't made of the single best item. It's the exact combination of items that maximizes your survival odds for a specific rigid weight limit.
That makes perfect sense.
In finance, the mathematical process of finding that perfect mix of assets is called mean-variance optimization. It weighs the expected return, which is the mean, against the volatility, which is the variance, of the combined assets.
So it's basically mathematically packing the perfect backpack?
Exactly. And if you run that process perfectly, you arrive at the absolute edge of what is mathematically possible. In our analogy, that's the maximum survival utility you can possibly fit into exactly 40 pounds of gear without ripping the canvas.
And what's that edge called?
In finance, we call that edge the efficient frontier. It is a mathematical curve representing all the portfolios that squeeze the maximum expected return out of a given level of risk.
Okay, I can visualize that.
Below that curve, you are packing poorly. You're bringing unneeded weight, leaving survival points on the table. And above that curve, well, you simply cannot go. It's physically impossible. Markowitz gave us the map to the efficient frontier.
I have to say, I am entirely on the side of Markowitz here. That sounds incredibly logical. I mean, if I'm managing a pension fund, I want my survival backpack packed perfectly. I don't want to leave anything to chance, and I certainly don't want to be below that curve, leaving returns on the table.
Of course not.
I want to be exactly on that efficient frontier. So let's return to the 1980s trading floor. Put me in the shoes of a mid-sized pension fund manager back then. I have billions of dollars to allocate across, let's say, 20 different asset classes.
Okay, 20 classes.
Right. I have large cap domestic stocks, international equities, government bonds, highly rated corporate bonds, real estate investment trusts, maybe some commodities. I have a mainframe computer. I have the Markowitz formula.
You're ready to go.
Yeah, I sit down, feed the historical data into the machine, and run the mean variance optimization to find my efficient frontier. What actually happens when I hit the enter key? Because if the theory is flawless, the output should be a beautifully balanced portfolio, right?
Well, when you hit the enter key, the computer processes the historical data and spits out a portfolio that looks absolutely bizarre.
Bizarre how?
Remember, you have 20 asset classes that a normal, rational human committee would probably divide up somewhat evenly. They might put 30% in broad bonds, 40% in domestic stocks, 10% in real estate, and so on. But the Markowitz machine outputs absolute insanity.
Like what? What are we talking about here?
It tells you to put exactly 0% of your money into 3 of your core, highly reliable domestic asset classes. It completely ignores U.S. government bonds.
Wait, 0% in government bonds?
0. It then demands you put 72% of your entire multi-billion-dollar fund into one obscure, highly volatile international equity sector.
You're kidding. 72% in one obscure sector.
Yes. And just to make things completely impossible to execute in reality, it demands you take a massive 18% short position in another standard asset class, meaning it wants you to borrow shares you don't own, sell them, and hope the price crashes.
That is, that's completely unhinged.
It looks nothing like a human-constructed portfolio, and it looks absolutely nothing like the benchmark index you are paid millions of dollars to track.
So if I'm in the pension manager and I take that printout into the quarterly investment committee meeting.
Oh, if you say, here is our new mathematically perfect allocation, the committee will look at the 72% concentration in one obscure asset, conclude you have completely lost your mind, and fire you on the spot.
Wow. So they literally couldn't use it?
They couldn't. So managers in 1989 didn't show the printout to the committee. They ran the math, saw the crazy output, physically threw the printout in the trash can, and went into a conference room to argue about the allocation for 2 hours based on their gut feelings and industry rules of thumb.
And the academics just thought they were being stubborn.
Yes, academics sitting in their ivory towers looking at this behavior assumed the practitioners were just intellectually lazy or terrible at math. But Richard Michaud realized the practitioners were simply surviving. They knew the machine was outputting toxic career-ending recommendations.
So Michaud set out to figure out why the math was breaking.
Exactly. The profound puzzle Michaud set out to solve was why a mathematically perfect system, a Nobel-worthy piece of pure logic, consistently generated such extreme, unusable garbage when applied to real-world data.
Wait, let me push back on this before we look at Michaud's exact findings. I refuse to believe the system was just randomly generating garbage. I mean, if I'm a quantitative analyst in 1989, I'm not just going to throw my hands up and say the math is toxic. I'm going to prove it with data.
Right.
Most finance papers I read involve a researcher taking like 50 years of stock market history, running a massive historical regression, and looking for patterns to prove a model works or fails. I assume Michaud just ran a bigger, longer, more comprehensive backtest than everyone else.
You'd think so, but no.
No? Didn't he just take 40 years of S&P 500 returns, run the optimizer, and show that the resulting portfolio crashed and burned during the 1987 Black Monday crash? I mean, that's how he just models. We run historical backtests.
No, he didn't do that at all. And that is what makes his work so revolutionary. Michaud knew that running a standard historical regression, looking at past stock returns, wouldn't prove anything to the academics.
Why not?
Because they would just argue that his backtest was flawed or that he picked the wrong historical time period. You can always torture the data in a backtest. Instead, he did something much more elegant. He ran a conceptual simulation based purely on the internal architecture of the optimizer itself.
Like testing the gears of the machine?
Yes. He treated the Markowitz formula not as a financial tool, but like an aircraft engine on a test stand. He was trying to understand its internal tolerances and breaking points.
Okay, how did he do that?
He took the standard widely accepted inputs that any Wall Street pension analyst in 1988 would have been feeding into the machine, the standard expected returns for U.S. stocks, corporate bonds, and real estate. Then he performed an action called perturbation.
Perturbation, just like disturbing the system?
Exactly. Perturbation just means taking a steady state and wiggling it slightly to see how the whole system reacts.
Michaud would take the expected return of U.S. equities, let's say the consensus estimate was 10%, and he would perturb it to 10.5%.
Just a tiny 0.5% nudge, a tiny, seemingly insignificant 0.5% nudge. He kept every other number in the massive spreadsheet exactly the same and reran the optimizer to see how much that optimal survival backpack changed based on that tiny whisper of a change.
Okay, before we get into the explosive results of that wiggling, I feel like we really need to clarify what these inputs actually represent. How do finance professionals even measure them?
That's a crucial point.
Yeah, I mean, when you talk about the expected returns and the inputs we feed the machine, I know there are highly specific metrics analysts use to quantify past performance and risk before they even touch the optimizer. I want everyday analogies first to really ground this, and then the formal definitions for the metrics they use to evaluate these inputs.
Sure.
How exactly are they measuring the quality of an asset?
Let's imagine you're evaluating a vast fleet of sailboats racing across the open ocean. The speed a boat travels is determined by two completely different independent forces. First, there is the natural current of the ocean and the prevailing wind.
Okay, the environment.
Right. If a massive storm system is blowing at 40 knots, every single boat is going to move incredibly fast, regardless of who is steering the ship. The worst captain in the world will still cross the finish line quickly because the wind is carrying him.
Makes sense.
In finance, that natural market-wide movement is called beta. Beta formally measures how much an individual asset moves in response to the broader market. If the overall stock market goes up 10% in a year, an asset with a beta of exactly 1 goes up 10% right alongside it. It is the tide lifting all boats.
Okay, so beta's the wind. What's the second force?
The second force is the specific, unique skill of the captain.
A brilliant captain might find a special thermal draft or trim the sails perfectly to catch a slight edge, generating extra speed that has absolutely nothing to do with the prevailing wind.
Ah, so that's what everyone is looking for.
Exactly. In finance, that unique captain-driven excess return is called alpha. Alpha formally represents the active return on an investment compared to a market index, isolating the value added by the manager's specific idiosyncratic choices rather than broad market movements.
Got it. Beta is the market wind, alpha is the captain's skill. Is there anything else? Yes, finally, you have to evaluate the ride itself. A boat might cross the finish line first, but only by plowing through massive, terrifying storms that nearly capsized the vessel and terrified the crew. Meanwhile, another boat arrived slightly later, but took a perfectly smooth, safe, calculated route.
Most people would probably prefer the second boat.
Right. You want to know the ratio of the speed achieved to the turbulence endured. In finance, that metric is the Sharpe ratio.
The Sharpe ratio. Okay.
The Sharpe ratio measures the performance of an investment adjusted for its risk. It's calculated by taking the expected return of the investment, subtracting the risk-free rate, like a treasury bond, and dividing that number by the standard deviation of the returns.
So it's basically a smoothness score.
It essentially tells you how much excess return you are getting to compensate you for every unit of volatility and sleeplessness you suffer.
Okay, so the quantitative analyst sits at their desk, calculates the beta to understand the market wind, searches for the captain's alpha, checks the Sharpe ratio to ensure the ride isn't too volatile, and uses all of this historical data to formulate their expected return for the next year.
That's the process, yes.
And they plug that highly researched expected return into the machine. Now, you mentioned Michaud took that carefully calculated input and wiggled it by 0.5%. Why is that 0.5% wiggle so critical? Because I'm going to push back again here.
Go ahead.
If we have decades of stock market history, shouldn't we have a precise enough number to just feed the calculator and trust it? I mean, we have supercomputers. We can track the S&P 500 back to the 1920s. We know exactly what the long-term averages are. Why are we acting like a 0.5% wiggle is a systemic flaw?
Because you are making the exact same fundamental mistake the academics made in the 1980s. You are equating observing financial markets with observing the laws of physics.
How are they different? Data is data, right?
Not at all. If I stand on the roof of a building and drop a heavy iron ball thousands of times, measuring its descent with lasers, I can calculate the gravitational constant to incredible decimal level precision. The historical data of gravity perfectly predicts the future data of gravity.
Right. Gravity doesn't change.
Gravity doesn't change its mind. But financial markets are not physics. Historical averages in finance are incredibly, violently noisy. If you estimate the expected return of the U.S. stock market based on 20 years of historical data, your estimate comes with a statistical margin of error.
Okay, standard error.
Yes, in statistics, this concept is called the standard error. And in finance, the standard error for expected market returns isn't a tiny decimal. It is absolutely monstrous. If your historical data tells you the expected return is 9%, the true expected return for the next year could easily be 4%, or it could be 14%.
Wow. So it's a huge range.
Huge! A standard error of that magnitude is not a rounding error. It is a wrecking ball swinging straight toward the delicate mathematics of the Markowitz formula. You think you are handing the machine a perfectly machined titanium gear, but you're actually handing it a block of soft clay.
So the input we give the machine, despite all our fancy alpha and beta calculations, is basically a highly educated guess disguised as a precise scientific measurement.
Yes.
We hand the machine a number like 9.2%, but reality dictates it could be anywhere from 4 to 14%. That leads us directly to Richard Michaud's core finding. What did he discover when he put the engine on the test stand, wiggled the inputs by 0.5%, and hit the optimizer with that wrecking ball of statistical uncertainty?
He summarized his discovery in one devastating sentence. This is the exact quote from the 1989 paper, and it is arguably the most important sentence written in modern portfolio theory.
Lay it on me.
Mean-variance optimization maximizes the effects of errors in its inputs.
Maximizes the effects of errors in its inputs, meaning it takes the wrong data and leans into it?
Exactly. The machine does not know that your inputs are just educated guesses. It has no capacity for doubt. It treats your estimated 9.2% return as absolute, undeniable, universally repeatable truth.
Oh, I see.
So if you estimate that asset A has an expected return of 9% and asset B has an expected return of 10%, The optimizer looks at that 1% gap and treats it as a massive, guaranteed, risk-free advantage.
Even though that 1% could just be statistical noise.
Exactly. But the machine decides it must exploit that advantage to the absolute mathematical limit. It tilts the portfolio entirely into the asset that appears best on paper.
Meaning it dumps all the money into the noise.
Yes. The core mechanism here is that the optimizer blindly trusts the data you feed it. And Michaud mathematically proved that the assets that get those massive 72% allocations in the crazy printouts are almost always the exact assets whose expected returns you have overestimated the most by mistake.
That is a fascinating conclusion, but I really need a way to visualize that mechanism. How does a complex algorithm get tricked so easily by our bad estimates? If I build an algorithm, I usually put constraints on it to ignore outliers. Why does Markowitz's Nobel-winning math actively seek out the worst estimates and bet the farm on them?
Okay, picture this. Imagine a diligent, mathematically brilliant, but completely socially oblivious student sitting in a large university lecture hall.
Okay.
This student represents the optimization algorithm. Scattered throughout the hall are 20 people representing the 20 different asset classes. Now, these 20 people are all whispering very softly, offering generally good, reliable, well-researched information about what will actually be on the final exam.
The reliable, normal data.
Right. But in the back row, there is one person who happens to be shouting at the absolute top of their lungs, just yelling absolute nonsense and completely fabricated study guide answers.
The error in the data.
Yes. Now, the student, lacking any human common sense or ability to judge character, operates on a rigid rule. Whoever provides the strongest, loudest signal must have the most valuable, certain information.
Oh no.
Yes. The student completely ignores the soft-spoken people who actually know the material and furiously writes down everything the shouting maniac says. In the optimizer, the shouter is the asset with the largest estimation error.
So the machine literally seeks out the loudest noise.
Exactly. If an asset's historical data randomly spikes due to pure noise, the optimizer assumes that loud noise is a strong, permanent signal of future outperformance, and it bets the entire portfolio on that error.
So the more extreme an asset's historical performance was, the more likely the optimizer is to assume it's a permanent feature rather than a temporary fluke. It finds the loudest shouter and gives them all the money.
You nailed it.
That means the very sophistication of the tool becomes its fatal flaw. But if the sophisticated tool is just an error maximizer, what is the alternative? Did Michaud find that a simpler approach actually works better in the real world? Or did he just tear down the old system without offering a replacement?
He did find an alternative. And, well, the reality of it is deeply humiliating for the multi-billion-dollar quantitative finance industry.
Humiliating how?
Michaud found that an unconstrained optimizer often performs significantly worse than the absolute dumbest benchmark you could possibly construct.
What's the dumbest benchmark?
The dumbest, lowest effort rule in all of finance is equal weighting, where you just divide your money evenly across all available assets. If you have 20 assets, you put exactly 5% of your money in each.
No math at all.
No math, no optimization, no historical regressions, no assumptions about the future.
And that beats the Nobel Prize winning formula?
Yes. Michaud demonstrated that because the sophisticated optimizer aggressively bets on the loudest shouter, it frequently loses to the completely ignorant equal-weighted portfolio. Equal weighting wins precisely because it humbly admits it knows nothing about the future, whereas the optimizer fails spectacularly because it falsely assumes it knows everything with perfect certainty.
It's hard to wrap my head around the idea that just, dividing by 20 beats a Nobel Prize-winning formula just because it avoids the shouter. But surely Michaud didn't just walk away and say, everyone, equal weight their portfolios forever. Did he offer any way to rescue the optimization process, any tweak to the inputs that makes the math behave reasonably?
He did, and he offered a crucial reframing that completely changed the trajectory of the industry. He showed that if you stop trying to optimize based on total returns and instead force the machine to optimize based on residual returns, the tool becomes far more informative and stable.
Residual returns.
I'm going to need an analogy for that before we define it.
Let's use cars. Imagine you were shopping for a new car. You could judge cars by their brand's badge on the hood: Ford, Honda, Toyota. That is like looking at the total return of a stock. You're just looking at the broad category.
Okay, the whole package.
Right, but really what you care about as a driver are the underlying physical traits of the vehicle: the fuel efficiency, the horsepower, the crash safety rating. A specific Honda and a specific Toyota might actually share the exact same underlying fuel efficiency trait, even though they have different badges.
Right. They share a characteristic.
In finance, those underlying traits that drive performance, regardless of the brand name of the stock, are called factors.
Factors.
Formally, factor investing is an investment approach that targets specific, quantifiable drivers of return that explain performance across diverse asset classes, such as the value factor, the momentum factor, or the size factor.
So instead of buying Apple, you're buying momentum.
Exactly. Michaud showed that if you strip out the broad market wind, the beta we discussed earlier with the sailboats, and force the optimizer to look only at the residual returns, meaning the specific alpha and factor traits that are unique to the asset, the optimizer behaves much better.
Because it's looking at the engine, not the badge.
Yes, it stops chasing the massive, noisy market swings and focuses on the stable underlying traits. By focusing on residual returns instead of total returns, Michaud essentially predicted the multi-trillion-dollar factor investing revolution a full decade before it became the industry standard.
I see. So by stripping out the noise of the broad market ocean current, you give the optimizer cleaner, more stable traits to look at.
Precisely.
But I want to go deeper into the physical mechanics of why the machine fails so spectacularly when left unconstrained with total returns. Because you said earlier that the math turns a tiny whisper of an error into a 72% allocation, I'm struggling to visualize how that explosion actually happens.
It's unintuitive, I know.
Yeah, I don't want any complex formulas or Greek letters, but I want to visualize the math purely through intuition. How exactly does the architecture of the formula take a 0.5% estimation error and turn it into a multi-billion-dollar mistake?
To visualize the pure math without the equations, let's build a mental model of a giant spreadsheet. In column A, you have your input, the expected return you estimate for a specific asset based on its history. In column B, you have the output, the percentage allocation the machine decides to give that asset in the final portfolio.
Okay, input A, output B.
The linkage between column A and column B is the mathematical heart of the optimizer. In a sensible, human-designed engineering system, that linkage would be gentle and proportional. If you increase the expected return in column A by 1%, the allocation in column B should go up by a small, proportional amount, maybe 2 or 3%.
That's how normal things work.
Right. But in Markowitz's system, the linkage is not gentle. Imagine a massive megaphone connected directly to a highly sensitive balance scale.
A megaphone and a scale?
A balance scale is designed to weigh evidence gently, comparing the relative weight of two items. But Markowitz wired the scale directly into the megaphone. If there is the faintest whisper of an error in your estimated input, a tiny fraction of a percent of statistical noise in column A, the mathematical linkage amplifies it through the megaphone.
And it blows out the scale.
It comes out as a deafening roar on the allocation side in column B. The tiny whisper of error instantly slams the balance scale entirely to one side, demanding you put all your money in that one asset.
Okay, but what exactly is the megaphone? I understand the input and output, but what specific mathematical component inside the algorithm is taking that whisper and deciding to amplify it into a roar?
The megaphone is created by how the assets relate to one another, specifically their covariance.
Covariance. Okay, define that for me.
Before I define covariance formally, picture a very delicate baby mobile hanging over a crib. It has 20 little wooden butterflies representing your 20 assets, perfectly balanced on thin wires.
I'm picturing it.
If you reach out and gently tap one butterfly, a well-designed, loosely strung mobile will wobble slightly, dissipate the energy through the strings, and settle back down into equilibrium.
Right, it absorbs the shock.
But now imagine a rigged, dangerously tightly strung baby mobile. Because the wires are pulled so incredibly tight, tapping just one butterfly sends a violent shock wave through the entire structure, causing the whole thing to swing wildly across the room and tangle itself into an unfixable knot.
That sounds chaotic.
It is. That tightly strung linkage is covariance. Formally, covariance is a statistical measure of the directional relationship between two asset prices. It evaluates how two variables move together over time. If they consistently move in the same direction, they have positive covariance.
Okay, so they move together.
The optimizer uses an incredibly complex grid of these relationships called an inverse covariance matrix. When assets are highly correlated, meaning they tend to move up and down together, the mathematical inversion of that matrix becomes violently unstable. It becomes the rigged baby mobile.
So the math forces them to be too closely tied together. Exactly. The tiniest breeze of input noise from your expected returns hits that tightly wound matrix, and the entire portfolio swings violently into extreme polarized allocations. If the fundamental problem is that assets moving together creates this rigged baby mobile effect, I feel like there's an obvious solution here. Why do we not simply find assets that do not move together?
Oh, if only it were that easy.
Seriously. Can we not just pick completely uncorrelated assets like, I don't know, pairing domestic stocks with physical gold or real estate with government bonds, remove the megaphone entirely, and let the balance scale work gently? If we just untangle the baby mobile, the optimizer should work perfectly.
That is the beautiful dream of diversification. But it is destroyed by the cruel reality of financial markets. You cannot escape the megaphone because assets are always correlated in regimes.
Regimes?
Yes, there is simply no such thing as 20 completely independent, uncorrelated assets in a modern, hyper-connected global economy. Large cap stocks move together, corporate bonds move together, and during a severe market panic, a liquidity crisis, or a specific macroeconomic regime like high inflation, everything moves together.
Right, like when the whole market tanks.
Exactly. In 2008, the correlation of almost every asset class went straight to 1. They all crashed simultaneously. The wires of the baby mobile are always tightly strung by the reality of global capital flows. The megaphone is always in the room.
Always.
Always. Because you can never find perfectly uncorrelated assets in the real world. The inverse covariance matrix will always be unstable, and the unconstrained optimizer will always be hypersensitive to your noisy inputs. It is mathematically trapped by its own elegance.
Okay, we have thoroughly dismantled the 1989 trading floor. I now completely understand why the senior portfolio manager threw the Nobel recipe in the trash. The machine is a rigged baby mobile, a megaphone connected to a delicate scale, constantly amplifying the loudest, most erroneous shouter in the room.
That's a perfect summary.
But we do not live in 1989 anymore. It is decades later. We have massive computing power, entirely new financial structures, and an army of quant PhDs working on this. How has Michaud's devastating finding shaped the modern infrastructure of finance?
It's shaped everything.
Well, millions of regular people today use automated robo-advisors to manage their retirement. When I deposit part of my paycheck into an automated app on my phone, does that robo-advisor use the broken Markowitz optimizer, or did they figure out a way to put heavy guardrails on the megaphone?
Modern finance is entirely built on top of the guardrails, designed specifically to fix the problem Michaud diagnosed. No reputable robo-advisor or institutional manager runs a raw, unconstrained mean-variance optimization today.
Okay, good. So what do?
They use a model that was built specifically to solve the error maximization problem. To understand it, let's use an analogy about driving. Imagine you are using a GPS app to drive all the way across the country.
All right.
Left entirely to your own devices, you might try to guess the absolute fastest backroads, taking a wild, zigzagging sequence of dirt path that your brain thinks might save 10 minutes, but could easily leave you stranded in a ditch with a flat tire.
That's the raw optimizer.
That is the raw Markowitz optimizer. A much better GPS system starts with the standard safe, well-paved interstate route that millions of other cars have proven works
the default equilibrium. You only deviate from that proven interstate if you have highly specific, high-confidence local knowledge about a particular shortcut.
Start safe, tweak slightly.
Exactly. In finance, that GPS default route is the Black-Litterman model. Formally developed by Fisher Black and Robert Litterman at Goldman Sachs in 1992, the Black-Litterman model is a portfolio allocation formula that starts with the global market's current capitalization weights as its cautious baseline equilibrium.
So it starts with what everyone else is doing.
Right. And then it uses complex mathematics to blend those baseline weights with the investor's specific stated views to generate stable, well-behaved allocations. Robo-advisors today start with the Black-Litterman equilibrium. They assume the broader market is generally right, and they only tilt your portfolio slightly based on your age or risk tolerance.
So Black-Litterman forces the machine to respect the wisdom of the crowd, the global market cap, before it starts making wild bets. It anchors the math to reality.
Exactly.
Are there other mathematical guardrails used by the institutions managing larger pools of capital? Like, how do the massive hedge funds silence the megaphone?
Yes, another major mathematical innovation designed to silence the megaphone is a highly specific statistical technique that reins in extreme noise in the covariance matrix.
How does that work?
Imagine a professional baseball player who gets called up to the major leagues and suddenly hits 4 home runs in his very first 4 at-bats of the season.
Unbelievable start.
A naive statistical model might look at that 100% success rate and predict he will hit a home run every single time he steps to the plate for the rest of his 15-year career.
Which obviously won't happen.
Right. A smart statistician knows about regression to the mean. They would forcefully pull that 100% success rate back toward the historical average of a normal good baseball player. In quantitative finance, that deliberate mathematical pulling back of extreme data points is called shrinkage.
Shrinkage, like literally shrinking the data?
Yes. Formally, shrinkage is a statistical technique pioneered in finance by Olivier Ledoux and Michael Wolff that systematically reduces the estimation error in covariance matrices by pulling extreme historical correlations partway back toward a more stable, highly structured average.
They're reining it in.
Ledoux and Wolff mathematically proved the optimal intensity to blend the noisy sample data with a rigid target matrix. By mathematically suppressing the extreme data points, shrinkage literally turns down the volume on the megaphone, allowing the optimizer to function without tearing the portfolio apart.
I see. We shrink the extreme data points so the machine doesn't overreact to the guy hitting 4 home runs. We force it to be skeptical.
Precisely.
But earlier you mentioned that the absolute dumbest rule, equal weighting, actually beats the raw optimizer out of sample. I want to challenge that. Was that just a quirk of Michaud's specific 1989 dataset, or did that hold true over the long run? Because if equal weighting always wins, why are we bothering with Black-Litterman or shrinkage at all?
It absolutely held true, and it became one of the most famous and humbling findings in modern finance. In 2009, 3 researchers, Victor de Miguel, Lorenzo Garlappi, and Ramon Uppel, published a massive, exhaustive study comparing 14 different, highly sophisticated optimization models against the incredibly simple 1/n rule, which is just equal weighting.
14 different models? And?
They didn't just look at one data set. They tested it across 7 completely different empirical data sets, covering decades of market history. And they found that none of the complex optimizers, not even the ones with advanced constraints or early shrinkage techniques, could consistently and reliably beat the dumb 1/n portfolio in rigorous out-of-sample testing.
None of them?
None. The sophisticated models looked like absolute genius in the back test, fitting the historical noise perfectly and generating beautiful, efficient frontiers. But they completely failed to deliver in the real, unpredictable, messy future.
That brings us directly to today. It is 2026. We are currently living through an unprecedented machine learning revolution.
Oh, yes, we are.
Every major hedge fund and asset manager is boasting about their proprietary AI pipelines. They're pulling in petabytes of alternative data, analyzing satellite imagery of retail parking lots, and using natural language processing to read every central bank speech in milliseconds to predict stock returns. I have to assume the inputs are no longer noisy.
You would assume that, yes.
So are these new machine learning models immune to Michaud's critique? Or are they falling into the exact same trap the pension manager did in 1989?
They are absolutely vulnerable to the exact same trap. And in many ways, the danger is significantly higher now because the models are so opaque.
Higher? Why?
A modern machine learning model can ingest billions of data points and generate a highly complex, nonlinear expected return estimate for thousands of interconnected assets. The data engineers look at the output and marvel at the sophistication of the AI's prediction. But here is the critical failure point that they often overlook. That brilliant machine learning prediction still has to be translated into a physical portfolio.
You still have to buy the stocks.
You still have to decide exactly how many shares of Apple or IBM to buy. If an engineering team feeds the outputs of a cutting-edge neural network directly into a raw, unconstrained mean-variance optimizer, they have completely wasted their multi-million-dollar technology.
Because the optimizer is still just a megaphone?
Exactly. The optimizer does not care that a neural network generated the inputs. It will still treat the slightest estimation noise, which always exists out of sample, as absolute truth. Because ML models find highly complex relationships, the inputs they feed to the optimizer are often even more prone to out-of-sample failure.
It amplifies the AI's mistakes.
Yes. The machine learning pipeline just becomes a vastly more expensive, highly complex error maximizer. Now, the smart battle-tested quantitative shops in 2026 know this. They heavily constrain their ML models using robust optimization and strict position limits. But history shows us that every single time a new generation of technologists enters finance, they fall in love with the math, forget this lesson, build a raw optimizer, and have to relearn Michaud's critique the hard way, usually after losing hundreds of millions of dollars in a sudden market shock.
As someone who just wants to know what to do with their money, this is a massive amount of information to process. The Nobel-winning optimizer is fundamentally broken, the cutting-edge AI is vulnerable to the exact same trap, and the professionals are just slapping mathematical guardrails on a flawed machine to keep it from exploding.
That's the reality of it.
What is the actionable advice for an everyday retail investor listening to this? If I log into my brokerage account today and use their automated portfolio recommendation tool, how do I practically protect myself from the error maximizer?
The actionable advice is remarkably straightforward, and it relies on your own common sense. First, look closely at the final allocation the software tool suggests. If the algorithm recommends putting 50% or more of your wealth into a single asset class or sector, immediately assume the tool is severely infected with statistical noise.
It's found a shouter.
It hasn't found a genius shortcut. It has just found a loud shouter in the room. You must actively soften the machine's absolute confidence, manually override the tool, and cap any single position at 20 to 25% maximum, no matter how good the backtest looks.
Okay, cap it at 25%.
Second, do not chase the theoretical efficient frontier by constantly rerunning the tool and shifting your money every month. Establish a broad, well-diversified baseline, very similar to the dumb 1/n concept, and rebalance gently and infrequently. Do not let the software's mathematical arrogance become your financial ruin.
I really like that rule. Cap positions at 25% and ignore extreme recommendations. But I want to go back and close the loop on Richard Michaud himself.
Michaud, yeah.
It is one thing to point out that the house is burning down. It is another thing entirely to build a working fire extinguisher. Did Michaud actually invent a mathematical solution to the error maximization problem he discovered? Or did he just write the paper, point out the fatal flaw, and walk away?
He absolutely tried to build the fire extinguisher. Michaud didn't just complain, he proposed his own mathematically rigorous solution, a concept he called resampled efficiency.
Resampled efficiency, how did that work?
The logic behind it was brilliant in its pragmatism. If the fundamental problem is that the optimizer is blindly confident in a single, noisy estimate, the solution is to forcefully subject the optimizer to the experience of uncertainty.
So you teach the machine to doubt?
Yes. In Michaud's system, you do not just run the optimizer once on your historical data.
You use a computer simulation called Monte Carlo to generate thousands of slightly different, artificially mutated versions of the expected returns, representing the statistical noise that you know exists in the real world.
You make thousands of alternate realities?
You run the optimizer thousands of times on these mutated datasets, generating thousands of completely different optimal portfolios. Then you simply average all of those thousands of portfolios together.
And that works?
The extreme crazy bets cancel each other out in the averaging process, and the resulting average portfolio is vastly more diversified, stable, and reasonable. Michaud was so highly confident in this brute force solution that he patented the process in 1998 and built a very successful asset management company around it.
That sounds like a complete and total victory. He found the bug in 1989, he wrote the patch, he mathematically simulated it, he patented it in 1998, and he solved the Markowitz optimization enigma once and for all. Case closed, the good guys win, right?
Not exactly. This is where the story gets deeply fascinating, because an intense, highly technical academic war broke out over Michaud's fix.
Oh, of course, academics.
Right. You see, while resampling makes intuitive sense to a practitioner, averaging things out usually works, many quantitative purists argued that it was fundamentally a hack. It completely lacked a cohesive theoretical foundation. And the pushback came from the very top of the academic hierarchy.
Who pushed back?
In 2003, Harry Markowitz himself, the man who invented the original formula, alongside researcher Nilüfer Usman, published a major paper attempting to defend the classical approach against Michaud's critique. They designed an incredibly rigorous test. They pitted Michaud's patented resampling technique against alternative, highly theoretical approaches to see which was truly mathematically superior at handling noise.
What was the alternative approach Markowitz championed in that 2003 paper? I know we need to understand the Bayesian perspective here. Give me the everyday analogy first, and then the formal definition of what a Bayesian approach actually is in this context.
Imagine a deeply seasoned, veteran homicide detective arriving at a messy crime scene. A naive rookie cop might look at the very first muddy footprint they find and immediately conclude they know exactly who committed the crime, putting 100% certainty on that single piece of fresh but noisy evidence.
The rookie is the raw optimizer.
Exactly. But the seasoned detective does not start from scratch. They arrive with deep, pre-existing knowledge about the neighborhood, the historical crime rates, the local gangs, and typical motives. When they see the footprint, they do not blindly follow it. They update their pre-existing beliefs based on the new clue, carefully blending their historical intuition with the fresh data.
So they weigh the new evidence against what they already know.
Right. In probability, this is called Bayesian updating. Formally, a Bayesian approach is a statistical framework that applies Bayes' theorem, where you begin with a prior belief or baseline probability, and then you mathematically update that probability as new relevant evidence becomes available.
How does that apply to a portfolio?
In portfolio construction, a Bayesian optimizer does not just blindly trust the immediate historical data. It starts with a strong, cautious prior belief, usually that all assets should offer risk-adjusted returns roughly similar to the broader market. And it only mathematically adjusts that core belief when the historical data provides overwhelming, statistically rigorous evidence to the contrary.
Got it.
Markowitz and Usman designed a massive simulation to compare Michaud's brute force resampling technique against these highly elegant Bayesian updating techniques.
So we have the brute force averager versus the seasoned Bayesian detective. Who won that academic war? Did Markowitz prove that the Bayesian detective was fundamentally better than Michaud's thousands of simulations?
The results of that specific 2003 test were messy and highly contested. Initially, Markowitz and Usman found that Michaud's resampling actually held up surprisingly well in their specific simulation environments.
Wait, so Michaud won?
Well, almost immediately, another highly prominent quantitative researcher named Bernd Schroer published a devastating rebuttal in the Financial Analysts Journal. Schroer looked at Michaud's work and argued that the entire comparison was structurally flawed.
How so?
He mathematically proved that for any resampled portfolio Michaud could generate using his thousands of simulations, A skilled statistician could reverse engineer a specific Bayesian prior that would achieve the exact same or better results. Schreyer argued that resampling was a new innovation at all. It was essentially just a clunky backdoor way of doing Bayesian statistics without admitting it.
Oh, wow.
And worse, he showed that the implicit prior Michaud was unknowingly using was often structurally irrational. The academic community was deeply split, but it got even worse for Michaud. Later, more advanced simulation studies, specifically a major 2013 paper by Hibelin, Gertler, and Becker, demonstrated that under many realistic market scenarios, the original plain Markowitz optimizer actually beat Michaud's resampled fix on average.
Really? The original broken one?
Yes, they found that the brute force averaging of resampling sometimes destroyed too much valuable, genuine signal in its aggressive attempt to eliminate the noise.
So the entire field was essentially paralyzed in a theoretical stalemate. The raw Markowitz optimizer is a dangerous error maximizer, but Michaud's patented fix was heavily criticized as a mathematical hack that sometimes performed even worse than the original problem. Where does the consensus actually stand today in the 2020s? After decades of fighting, have we finally found the definitive answer to portfolio construction?
The debate has continued right up to the present moment. In 2024, a major paper by Sexauer and Siegel, published in the Financial Analysts Journal, attempted to synthesize decades of this brutal academic conflict. They completely reframed the entire problem.
What was their conclusion?
They argued that Michaud's resampling is best understood historically as a crude early form of statistical optimization. It was a necessary stepping stone, but they concluded definitively that modern, cleaner Bayesian approaches fundamentally dominate Michaud's technique. The 2024 consensus is that you absolutely must account for estimation error. Michaud was 100% right about the illness in 1989, but his specific patented medicine is no longer considered the optimal cure.
It sounds like the ultimate truth of this entire exploration is that there's simply no perfect mathematical utopia. The unconstrained optimizer is incredibly dangerous, but no single genius, not Markowitz in 1952, not Michaud in 1989, not the advanced Bayesian statisticians today, has found a flawless, perfectly safe mathematical formula for risk-free wealth creation.
Complex financial ecosystem that learns a hard mathematical truth, slowly forgets it as new technologies and bull markets breed overconfidence, and is violently forced to relearn it during the next market crash. However, I want to add one final piece of context that significantly softens the blow of all this theoretical failure.
Please, give me some good news.
Everything Michaud critiqued in 1989 was based on a static, single-period optimization. It assumed you allocate your portfolio once, lock it in a vault, and are trapped with it forever. But in the real world, continuous rebalancing exists.
Right, we can change our minds.
We get to wake up tomorrow, observe new data, and adjust our positions. Research in the 2020s has shown that the simple act of regular, disciplined portfolio rebalancing acts as its own incredibly powerful error correction mechanism. It naturally trims the assets that have grown too large and risky, and it buys the ones that have shrunk. Continuous real-world rebalancing softens the cruelty of the single-period error maximizer.
We started by looking at a Nobel Prize winning recipe that was laughed at by the hardened professionals on a 1989 trading floor. We have unpacked the math, the metaphors, the megaphones, and the deep, bitter academic wars that followed. After dissecting all of this, the takeaway for anyone managing money, whether you are running a trillion-dollar pension fund, programming an AI hedge fund, or just allocating your own 401k, is profound. Every single portfolio tool that claims it has found the mathematically optimal allocation is really just showing you how blindly confident it is in its own noisy inputs. The more extreme the answer the machine gives you, the less confidence that answer actually deserves.
True financial wisdom is not about building a bigger megaphone. It is about having the humility to know exactly how loud the noise in the room really is, and having the discipline to walk away from the shouter.
This is the Research Desk officially signing off.